My name is Mark Jane. I'm a shareholder here at Butzel Long. I'm based in the Ann Arbor office. My colleague, Nicholas Hat, who will be taking the second half of this presentation, is in the Troy office. And we are going to present on some Secure Act 2.0 provisions that are taking effect, that either have taken effect or that will take effect in the next couple of years that might be of interest to you as possible plan sponsors or plan administrators. So let's get started. Next slide, please. Okay. Back in 2019, Congress approved and was signed into law on December 20th of the Further Consolidated Appropriations Act of 2020. That funding bill included the Setting Every Community Up for Retirement Enhancement Act of 2019. Now, you might be wondering why I'm bringing that up when we're talking about Secure 2.0. Well, 2.0 necessarily means there was a 1.0, and that original Secure Act of 2019 was essentially the first bite of the apple by Congress to try to address some retirement reforms, retirement plan reforms that have been bandied about for the last several years since the last major piece of legislation, the Pension Protection Act of 2006. After Secure Act was passed, there were some almost an immediate appetite for further reforms, and that was colloquially referred to as Secure 2.0. Well, after just a couple years in the Consolidated Appropriations Act 2023, which was signed on December 29th of 22, that's what happened. In Division T of that appropriations bill was the Secure 2.0 Act of 2022. And that law is going to be the focus of the discussion. That law included at least 88 new changes to retirement plans, some of which are required, but some merely permitted. Actually, a lot of them were merely optional. So a good part of our discussion today is going to kind of piece together what is required for you as a plan sponsor, plan administrator, and what might be optional that you might want to consider offering to your groups. Some of these have already taken effect, but some are going to be affected either very soon or in the next couple of years. This session focuses, though, on key required changes that will affect retirement plans within the next 2 years, and then we'll dovetail to Nick's discussion on some optional changes. Next slide, please. So where are we going today? I will start with a discussion on long-term part-time workers. Then I'll go into some updates on Roth catch-up contributions and finish up with a discussion on annual paper statements. Then Nick will take over and do some discussions on the annual funding notice, some RMDs for spouses, Roth accounts and requirement and distributions, and then, like I said, an overview of some changes. And then we will finish up with a question and answer session. So if next slide, please, we can dive in. Okay, we're going to start with the big one, the long-term part-time workers requirement. Now, I say requirement, it's a requirement for employer-sponsored 401k or 403 plans. But I want to give a quick 5,000-foot explanation of retirement plans just to catch everybody up so that we're all on the same, we're all level set. In the retirement plan universe, there are two general types of retirement plans. There's your defined benefit plan, there's your defined contribution. Defined benefit plans are retirement plans, typically colloquially referred to as pensions. In those plans, workers will accrue a benefit that they will know the finished benefit as they keep going along. And it's usually based on a calculation of either service, compensation, or some form of but essentially what a worker will know is that at any point they can see what they're going to be getting at retirement on usually a monthly basis. A defined contribution plan, on the other hand, you don't know what you won't know at any point. You'll have an idea usually you can do an estimate, but it's based on contributions accruing or being sent to the plan all the time. And so you have an account-based plan that your final benefit is based on what your account is valued at the time you start withdrawal. So Secure 2.0 heavily went with defined contribution plans. There were some provisions affecting defined benefit plans, but the large bulk of them impacted defined contribution plans, especially the options. And a subset of defined contribution plans are 401k and 403b plans. 401k usually for private or tax exempt employers, 403b specifically for tax exempt employers. Your commercial employers can't sponsor a 403b plan. So, but 401k and 403b plans both can have a type of feature known as elective deferrals. And what an elective deferral is an employee forgoes in advance a piece of their compensation in exchange for a contribution to their retirement plan, their 401k or their 403b. So usually that's on a pre-tax basis. So as we'll explain, soon there could be Roth elective deferrals in which the contribution is made on an after-tax basis. But for the sake of this discussion, we'll focus on the pre-tax elective deferrals. And these pre-tax elective deferrals are, for the sake of an example, somebody making $50,000 decides to forego 10% of their compensation. So that would be $5,000 per year. So they're really making $45,000 as far as the IRS is concerned for taxes. And then that $5,000, the employer is then sending to the 401k plan on a pre-tax basis. So what Secure 2.0 did is a lot of times employers will have service requirements, and in order to participate in the plan. Sometimes these service requirements will be 1 year of service before you can start participating. That includes elective deferrals. But what Congress did with the original Secure Act was they said, employers, if you have long-term part-time employees at the time of the Secure Act, was 3 years, but what Secure 2.0 did was reduce it to what Secure Act 1.0 did was set it at 3 years. Secure 2.0 reduced it to 2 years. If you have part-time employees and you have a requirement that somebody put in a year of service, and usually that year of service is 1,000 hours under discrimination rules. If you have that requirement, you must allow your part-time employees who have put in 500 years, or 500, not 500 years, 500 hours of credited service in 2 consecutive years, you have to give them the opportunity to make elective deferrals. This rule does not apply to collectively bargaining employees. And right now, while it's taken effect for 3 years, as I mentioned, Secure 2.0 will, for just this 1 year period, it's at 3 years, but it reduces down to 2 for plan years beginning after this year. Next slide, please. So what are some other things that Secure 2.0 did with this long-term part-time work? It made it clear that pre-2021 service is disregarded for both eligibility and vesting purposes. So that was a big confirmation, because there was some confusion whether or not you were supposed to disregard it for both. Now it's clear that is the case. Defined contribution plans need to allow these long-term part-time employees to participate for the elective deferrals, but not in employer contributions. So you do not have to open up other features of your 401k plan to your long-term part-time employees, as long as they're classified as long-term part-time employees. So that means you don't have to provide them matching. You don't have to provide them profit sharing contributions. You could if you want, and you certainly have to if they end up meeting the criteria of a garden variety eligible employee. But as long as they're a long-term part-time employee and you don't extend the employer contribution pieces to them, you only need to open up elective deferrals. You also do not need to count those employees in your plan's annual non-discrimination testing, although you could choose to do to, or you could choose to, should it be advantageous. Next slide, please. Once the part-time employee works the required hours for 2 consecutive years, you must allow them to contribute. There's essentially 2 types of entry date. It's the earlier of in this instance. So earlier of the first day of the plan year after they satisfy, or 6 months after the date the employee satisfied the requirements. So you can so at most, an employee, a long-term part-time can wait 6 months to start making elective deferrals. So, but it's so in this instance, it's the earlier of it. The first day of the plan year occurs less than 6 months in a less than 6 month time. You got to let them in. Individuals who would otherwise be eligible as long-term part-time may still be excluded if the exclusion is a reasonable classification that is not based on age or service. So where this might come into play is if you're a large employer that has multiple divisions and those divisions are based on locations throughout the United States, and you have a plan that only covers your East Coast participants, just because sometimes somebody's a long-term part-time employee, but they happen to be in the division that excludes employees on the west side of the United States, that's a general exclusion that's not based on age or service. Nobody from the West Coast is participating in that plan, so you don't have to let them in for that reason. You count hours starting on the date the employee's employment commenced, but if the employee does not complete the required hours during the initial 12-month period, you can then switch to the plan year. So for a quick example of that, let's say you hire somebody on July 1st. So you are going a July 1st of 2024 to June 30th of 2025. That's your first year, but then your second year would be January 1 of 2025 to December 31 of 2025. So that second 6 month period is essentially being counted twice. There's 2 years that you're looking at, but over a 1.5 year period. Vesting rules for employer contributions, if or once eligible, will change to under Secure 2.0 to provide that employees who participate in the plan as long-term part-time employees will be credited with a year of service for each year in which they perform 500 hours of service rather than the current 1,000 hours. So if you do provide employer contributions for them or employer contributions for these long-term part-time, the vesting rules are going to be based on that 500 hours of service. And as I mentioned, the Secure 2.0 is going to reduce that 3-year requirement to 2 years, but beginning. Next slide, please. So what are some takeaways? If you are an affected employer where you might have some of these long-term part-time employees, make sure that you're tracking hours and that payroll is submitting hours to the plan's record keeper. And you're just making sure that you have coordination for eligibility and vesting determinations, that everybody's on the same page. Have a process in place to identify newly eligible LTPT employees and provide enrollment materials to them. Make sure you're updating your plan documents and summary plan descriptions. As Nick's going to get into, the plan is not necessary to be amended at this time and won't be for a couple of years, but compliance is required even if the amendment is not made. And update your handbooks, enrollment forms, and other communications should this be at issue. Now, one last thing. I've mentioned about the 1,000 hour. If you have that in your plan and you might need to start counting 500 hours, there is one development that has occurred since 2.0 came out, and it's the IRS has confirmed that this is if you impose an eligibility service criteria on the plan or on an employee. If you just impose a waiting period, and that waiting period, some plans will impose like a 30-day waiting period, but everybody is eligible as long as they are employed for 30 days. You're not imposing a year of service requirement. I mean, you're not otherwise imposing that they work 1,000 hours. you're just saying you have to wait 30 days and then you're going to start participating. You don't have, if that's the case, you don't have any long-term part-time. Basically eligible, everyone's eligible. So you're not really, this doesn't really impact you. So that is the long discussion on long-term part-time. Now we're going to start moving into some other topics, probably faster because that was the long discussion. Next slide, please. Roth catch-up contributions. This one was a development from Secure 2.0 that caused a lot of headaches because it was going to take effect pretty quickly. The good news is, while it was intended to apply after December 31, 2023, there was a mistake in the language that actually, the statute actually eliminated all catch-up contributions. And there was a lot of administrative confusion at the record keeper and at the plan administrator level of how do we implement this. Some of our plans don't even have Roth contributions. So the IRS ended up delaying effectiveness for 2 years, which kind of gave a stay for a lot of plans to be able to get things in order to be able to implement this. But essentially, the high-level explanation of this is, if you are a 401k, 403b, or 457b plan that offers catch-up contributions, now these catch-up contributions are these additional contributions above the IRS limit for the IRS annual limit for your elective deferrals. These catch-up contributions, if your plan allows them, participants over age 50 with a prior year compensation over 145,000, you must make the contribution. They must make those catch-up contributions as Roth contributions, those after-tax contributions that I was referring to. Next slide, please. So a lot of administrators were confused, because they might not have offered Roth contributions, or there was almost this concern about, well, how do we bifurcate these contributions? Well, Secure 2.0 and IRS, hopefully IRS guidance, there was proposed rules that have come out last year, and we're hoping to get those with some comments and some finalization, some further clarification on them. There's some unanswered questions that we're looking to for further guidance on. The first thing that you could actually do is eliminate all catch-up contributions. That might cause some consternation by your workforce because they might be counting on those catch-up contributions, especially your higher paid employees, because that's that last period where they were going to be able to make up for the point where when they weren't making a lot of money early on and weren't able to max out their 401ks. They were kind of counting on these catch-up contributions to close that gap. So that is something to consider, that if you do eliminate the requirement, you might have some overall employee headaches for this, but at least you won't have to administer Roth at that. But if you do actually do the catch-up contributions, these Roth contributions, there's still some unanswered questions. It's not clear if catch-up contributions can be restricted to only those with 145,000 or less in FICA wages for the prior year. We don't think it's going to be allowed, but that might change. So that way you don't, if you are providing catch-up contributions, you're not providing, you're kind of capping them at that limit where they become Roth. It remains to be seen if that's going to be allowed. It's not clear if an employer, as opposed to eliminating all catch-up contributions, can require that essentially go the opposite direction, can require that all catch-up contributions be Roth, so all on that after-tax basis. That way you don't have to worry about, well, if somebody's hitting that income trigger, we now have to recharacterize the pre-tax to after-tax. And it's also not clear if an employer can avoid in a separate election for Roth catch-up by saying that all catch-up contributions will automatically be Roth for the affected participants. These are answers or questions that we're hoping guidance will answer. Next slide, please. It's important to remember that catch-up contributions, either may they be pre-tax or Roth, are not included in non-discrimination testing. I've mentioned about what these Roth are. I will like to know that, would you like you all to know that Roth accounts cannot be taken, and one of the special characteristics of this is a Roth deferral. It's made on an after-tax basis, but any earnings on it are essentially pre-tax. So once you take the distribution, if you made a $10,000 over the course of your time, $10,000 in catch-up of Roth contributions, and it ends up your investment earnings on that result in you have now $15,000. That $15,000 is not taxed when it's distributed to you. So that's the benefit of having the Roth. A lot of non-highly compensated employees like this because they can right now they might not be in a high tax bracket, so they don't see the benefit of as big of a benefit as the higher compensated employees with the graduated tax system. So they might want to make their after-tax contributions now so that they get the deferral of the earnings, so that they don't actually get taxed on the earnings. And when they receive the distribution, they might actually get a better benefit than somebody that's higher paid that is having this taken out with taxes at a higher tax bracket. But the trade-off of these Roth deferrals is, since taxes were already paid, the lack of a tax-free distribution only affects the earnings. So you have to wait 5 years on this, and that's essentially the rub. Like you're getting the tax-free distribution on the earnings, but you're having the trade-off is you're having to wait. That having to wait means you're going to have some former employees leaving their balances in the plan, so you're not able to clean out your plan of some account balances of employees that have left because they can't receive their distribution of these Roth yet. It might be, and if you do have these Roth, it might be a good idea to communicate these to employees when they leave employment that, hey, there's money that have to hold. Next slide, please. There's also some what happens in the event of an error, because that's one of the concerns, and one of the good reasons why there's a delay for a couple of years now is that there can't be any errors at the moment. But people are wondering now, like, well, what happens if a participant makes a pre-tax catch-up contribution, but it should have been on a Roth? We're waiting on guidance to see, like, maybe some options are you can reverse the pre-tax exclusion and provide a refund, adjust and recharacterize the catch-up as having been paid on a Roth basis, or just issue a refund of the pre-tax amount together with a 1090 call it a day. We'll see what the IRS has to say about that, but those are some potential options. Next slide, please. Finally, some takeaways. Again, this goes to making sure that the plan administrator, payroll, your TPA are all in lockstep. That the system is aligned and ready to go. That if you don't have Roth contributions, that you update your plan to permit or to have Roth contributions so that you can actually administer these. As I mentioned with the LTPT, plan documents and summary plan descriptions will need to be updated, although the actual amendment won't be needed for a couple of years. Election forms and enrollment materials should be updated. And also, this is an instance because this is kind of a different type of contribution that an employee can make. Consider providing education to your workforce. Next slide, please. Next item is on participant paper benefit statements. How Secure Act 2.0 changed this is defined contribution plans must provide a paper, not an electronic benefit statement, to plan participants. Normally, those have to be every quarter. One of those quarters has to be by paper. Defined benefit plans, when you provide those statements on an annual basis, 1 out of every 3 years needs to be by paper. There's an exception in Secure Act 2.0 for both the DC and DE plans that if you comply with that 2002 electronic disclosure safe harbor, so that one safe harbor that says, hey, if your workforce, a computer access is part of their job and necessary for their job, that disclosure exception still applies, so you can still provide these electronically. A participant can also affirmatively consent to an electronic distribution if you, that's another way to avoid paper, but the benchmark default rule is that you're going to have to provide paper benefit statements, either once a quarter for DC or once every 3 years for DB plans. And this requirement begins plan years starting after the end of next year. Next slide, please. The details won't be known until the Department of Labor updates relevant regulations and guidance, although it's supposed to do that by the end of this year. There might be an additional exception coming up in addition to the ones that were in the Secure Act, such as you might have a participant or beneficiary opt out completely of paper statements. So that way you just provide electronic disclosure, even if you didn't meet those safe harbor or the affirmative consent requirements. That remains to be seen. For plans that do use electronic distribution, make sure that your service agreements and your procedures are updated to produce and distribute these paper statements. And you might also need to update your electronic or your election forms so that you're addressing electronic distribution, so that participants are aware that could be but that is all I have, and now I will turn to Nick to discuss some other parts of the subscription.
Thanks, Mark. And just as a side note, although we're going to attempt to save some time at the end for questions, I noticed that some people did put some questions in chat and during Mark's presentation, and I was able to answer a couple of those. So you don't have to necessarily wait until the end. It may be possible for Mark to field a couple of those while I'm talking about some material. And as Mark alluded to begin with, there are two general families of plans: defined benefit and defined contribution plans, and the vast majority of changes affect defined contribution members of that family. I'm just going to begin to give you an overview by talking about one defined benefit required change, some defined contribution required changes, and then finish up with some optional changes. And as you will see, a lot of these provisions are still half-baked. Not recommended to be implemented anytime soon. This Secure 2.0 is in many ways like a company that releases a video game prematurely, and there are a lot of glitches in it. There is, however, one optional change that I will highly recommend. We'll get to that, so stay tuned. As I said, only of all the changes that apply to defined benefit or the Secure 2.0 changes that apply, there's only a few that apply to defined benefit plans. Let's look at this annual funding notice for defined benefit plans. So if you're a defined contribution person, I'll make this quick and as painless as possible. Both defined benefit and defined contribution plans have the phenomenon of receiving or sending notices to participants annually about the plan. Most of these end up deleted electronically or thrown in the trash. A lot of legal but necessary boilerplate. So this occurs with defined benefit plans as well as defined contribution plans. So the annual funding notice that we're talking about here is going to sound very familiar to defined contribution people, but with a few differences. So it tells you how well the pension plan is funded, the value of the pension plan's assets and liabilities, and how they're invested. There are also some legal limits on how much the PBGC, the government insurance agency, will pay if a pension plan ends or becomes insolvent. So beginning this year, this annual funding notice is going to be slightly modified. The new notice will be providing 3 years of financial information on a market value basis instead of just a valuation basis. 3 years of year-end participant count data and include an average return on plan assets for the year. The annual funding notice is also going to provide more information on how much the PBGC, that insurance agency, will guarantee, and we'll have to include some other information related to that. Now, next slide, please. Just some brief takeaways with that. As you can see, there's probably going to be a new model form. There is one that exists now, but that's probably going to be updated soon. And from a employer or TPA perspective, it might generate some additional questions. Some participants may notice the changes, not just press delete or toss it. It may generate some additional questions about funding for the plan. So maybe just be ready for those possibilities. Let's move on to slide 18. Required minimum distributions. Now, Secure 2.0 implements 2 major changes for required minimum distributions. Now, here you can wake up if you're a defined contribution person or in that family. So, because this will apply to both plans. The first big change applies to the RMD applicable age for all those plans. So first, we have some background here on the slide. The basic principle of the RMD rules is that a participant's benefit under a plan should be distributed either in full or before a required beginning date. Now, in general, the required beginning date, that is the date that the first RMD must be made from the plan, is the April 1st following the calendar year in which the individual attains the RMD applicable age. And now we're getting to the meat of the matter. It's the applicable ages that have been modified. The RMD applicable age had been 70 and a half until recent legislative changes under the Secure Act that Mark alluded to earlier. Under the Secure Act, the applicable age was raised to 72 for participants born on or after July 1st, 1949. So Secure 2.0 introduces some further increases for the RMD applicable age. First, to age 73 for participants born between January 1st, 1951 and December 31st, 1959. And second, to age 75 for participants born in 1960 or later. So to comply with those RMD changes, rules, plan administrators are going to need to track those required beginning dates for each participant, date of birth information for all participants and beneficiaries, and of course, safeguard that information in accordance with modern cybersecurity practices as enunciated by the DOL, or at least pay attention to that. Eh? Let's take it to the next slide for our next of the 2 major changes with regard to RMDs. And again, just for background, the rules in place prior to Secure 2.0 have generally been favorable to those inheriting IRAs and other retirement accounts from their spouse, from spouses in particular. For example, they were exempt from the limitations on the stretch IRA that was in place before 2020. Non-spousal beneficiaries lost that at that point. Let's particularly go concentrate on spouses because that's what Secure 2.0, this second major rule is. So let's move on to slide 19. So under Secure 2.0, the surviving spouse can now elect to be treated in the same fashion as the deceased spouse. That choice, which becomes available this year, allows for some additional planning options for that surviving spouse as a consequence. They can delay those required minimum distributions, for example, until the age the deceased spouse would have reached, for example. There's a slight change in the actuarial tables, the uniform life tables that they can use as well. But let's move on to slide 20 for the major takeaway. It looks like the next slide, takeaway. Sorry, back. Thank you. I have to be careful when I say that phrase. It looks like the major benefit of these new rules for surviving spouses will occur when the surviving spouse is older than the deceased spouse. Under that scenario, as I alluded to, the older surviving spouse could wait until the deceased spouse would reach the age where they were required to begin their RMDs. So obviously that allows those assets to grow on a tax-deferred basis. Now, there's an interesting element of film noir implication, I think. Good news for Black widows or widowers out there. It remains the case that if the spouse remarries and designates their new spouse as their sole beneficiary and then dies before commencing their RMDs, then the same treatment would be available to the new spouse. There might be some other regulations that change that, but that's an interesting implication for those whose minds might recall basic plots of film noir. And you can see the other takeaways on this slide. So let's go on to the next slide now and talk a little bit more about Roth accounts. So Mark talked a little bit about Roth accounts before. This particular change implicates our RMDs. So as of this year, designated Roth accounts in our family of defined contribution plans are going to be excluded from the RMD rules prior to the participant's death. But what does that mean? Well, as you may know or recall, in a regular Roth IRA, there are no RMDs required. That's one of the attractions of the Roth, is just being able to hold on to that pot of money after you pay taxes on it and let it grow. But now, no RMDs are going to be required from amounts held in our retirement plans during the life of the participant. So the rules are now all more in alignment with each other. I would just say as a side note that any distributions from these accounts that are required for a year prior to 2024, but are payable in 2024, are not affected by that change and are going to need to be made pursuant to the current rules. So let's get some additional takeaways with the next slide, please. And you can read them here. The main consequence practically perhaps are that if your affected plans are going to need to ensure that the distribution forms, notices, administrative procedures are all in place. You might need to update your service agreement and plan documents may need to be updated, notices, summary plan descriptions for that. Call your trusted employee benefits attorney, perhaps. Let's move on to the next slide and begin talking about some optional Secure 2.0 changes. We've got 3 to begin with here now. As I said, that there's a real raft. What is it? 80 something particular changes. So we're going to hit mostly a highlight reel here in as much time as we have. So the first of our 3 on this slide, the de minimis participation incentives are now permitted. So the Secure 2.0 now explicitly permits your employers, plan sponsors of your defined contribution plans to incentivize employees to participate by making a salary deferral election, which we know. Now there's a de minimis financial incentive that can also be paid, and not with plan assets. So this functions as an exception to the general rule that plan sponsors can't make any benefit contingent on an employee's decision whether or not to make a deferral election to a qualified plan. And recently, the IRS has issued guidance because it probably springs to your mind, well, what is de minimis? That's a little bit vague. Well, the IRS has told us that an amount is going to be de minimis if it does not exceed $250. So there we have at least something clear and definitive to work with. Now, unfortunately, these incentives can't be made to individuals who have already decided to participate in the plan. So too bad, so sad, but at least you've gotten that benefit of of participating in a retirement plan, right? Let's move on to the second of these 3, the matching and non-elective. Second of these 3, meaning we're still on the prior slide. The matching and non-elective contributions to designated Roth accounts. So I think we might want to go back 1 slide. Okay, well, let me talk about it. Under prior law, DC plan participants could designate only their elective deferrals as Roth contributions. Now, beginning in 2023, employer matching contributions, including matching contributions on qualified student loan repayments, more on that in a second, are also able to be considered Roth contributions. So that's a nice additional change for savers. It gives them another option. Now, the notice that described that didn't specifically address whether this was an optional or required change. The general consensus is, though, that it is an optional addition, although, as with many of these other rules, further guidance is probably coming. Another one of the reasons why the initial plan amendment deadline for 2025 was extended to 2026, giving everybody a little bit more time, especially the IRS and DOL, to formulate more guidance in a lot of these categories. The third item on this list is the emergency personal expense distribution. Now, generally, as you will recall, an additional 10% tax applies to early distributions from these retirement accounts, unless an exception applies. Now, there are several exceptions that do apply, and you may recall some of them are total and permanent disability, birth for certain expenses, separation from service after 55, death. So this is a new one. This is a new one. So Secure 2.0 provides an exception for certain distributions used for emergency expenses, which are unforeseeable or immediate financial needs relating to personal or family emergency expenses. Only one distribution is permissible per year of up to $1,000. and a participant has the option to repay the distribution within 3 years. No further emergency distributions are permissible during the 3-year repayment period unless repayment occurs. So, by the way, those are included in income in the year they're made, and this is a provision that is available now. Again, though, this is optional. We're on our optional changes here. Let's turn to slide 20, or the next slide, for additional optional changes. Our first one on this slide are, as you might have seen, pension plan linked emergency savings accounts. So a new feature plan sponsors might consider implementing in 2024 is the so-called pension linked emergency savings account, PLUSA. Now, individual account plans may offer to non-highly compensated employees a short-term savings account within the plan that accepts only designated Roth contributions. This plan feature would allow participants to save some modest amounts within the retirement plan that are nevertheless accessible to the participant without the occurrence of a distribution event, which we just had talked about. That might appeal to some perhaps lower income participants who might be reluctant to participate in a retirement plan, knowing that they can put some money there and take it out without a lot of additional hassle. Generally encouraging people to participate is one of these themes, as you might see, along with that de minimis incentive, for example. So let's move on to the second of these two on this page, the student loan payment matching contributions. So again, beginning this year, employers are permitted to make matching contributions to our, generally speaking, our defined contribution plans based on a participant's repayment of qualified student loans. The match may not apply to loan payment amounts that aggregated with the individual's elective deferrals exceed certain limits. So that's something to keep in mind. I think it's unlikely to reach those. And the match must be fair. It must apply exclusively to all participants who are eligible for matching contributions on elective deferrals and be at the same matching rate and subject to the same vesting rules as the elective deferral match. Let's move on to the next slide for some more options here. One of two here on this slide. First one's probably going to be one of the easier ones to implement: increased catch-up limits for certain participants. Beginning in 2025, or the 2025 calendar year, the Secure 2.0 Act will increase catch-up contribution limits for individuals aged 60 to 63. The higher limits are going to be the limit of the greater $10,000 indexed to inflation, or 150% of the regular catch-up limit for 2024. I imagine most plans are going to want to take advantage of that. There's still some lag time for implementation, so we'll probably get a little bit more guidance before that is it's implemented with administrators. The second item on this page for this slide involves qualified longevity annuity contracts, QLACs. Now, what is a QLAC? It's a particular type of annuity that can be bought with money from these qualified retirement accounts. So how do participants benefit? Well, it provides a way to delay required minimum distributions. You recall we talked about those earlier. Delay those RMDs in their associated taxes from the portion of the money used to buy this annuity. While at the same time, it can be part of a plan for living too long or living long or longevity insurance is how some people might put it. The Secure 2.0 liberalized some of the provisions that had restricted how much could be contributed before. Now, generally, we're speaking that you can contribute up to about or make available up to $200,000 of your account for this purpose. There are also now new exceptions for joint survivor rules and rules in the case of divorce. So it might, the hope is perhaps that people are going to use these for longevity, for planning out that a little bit further on in their life. There's a key limit. The QLAC deferral can only last up to age 85, and by that time you must start receiving those payment streams. So I think this is an intriguing step in the right direction, since people are living longer. It does prevent an interesting planning opportunity for participants, because essentially retirees have to balance their RMD requirements against their expected retirement income, especially as they age, and deferring some of that can add some flexibility. Now, you might consider, for example, that people living longer probably tend to enter or need assisted care nursing homes in their early 80s, which happens to align with the distribution requirements and starting times for a QLAC. So by using a QLAC, you're taking qualified dollars and allowing them to grow tax deferred until your early 80s. And then if nursing home expenses are being incurred after 80, those would be medical expenses, and at least under current law, tax deductible. So you'd be funding tax deductible long-term care expenses with tax deferred dollars. Not bad. Now, as you can see, though, there is an apparent drawback, because using the QLAC locks up a portion of your retirement funds, which could pose a challenge if you need them. But for people who have a whole comfortable amount, it could be a nice option. Let's move on to the next slide, and I'll proceed with a little bit more alacrity here. Now, early on, I mentioned one big no-brainer here, and this is it. This is. I don't see any reason why anybody's not implementing this right now. Your increased cash out limit maximum. Secure 2.0, it's simple, easy. The Secure 2.0, as you may already know, raises the threshold for mandatory cash outs from $5,000 to $7,000. So that's the amount you can distribute without consent. Now, so why is this great? Well, first of all, a lot of administration is done on a per capita basis, so the fewer participants you have, maybe you incur fewer expenses. Plans with secondly, plans with 100 or more participants generally have to submit themselves to an audit. So if you can get yourself under 100, maybe you can avoid an extra audit expense. If you have a terminated employee, you don't have to keep track of them as much with the benefits that they've earned. So again, simple, easy, no reason not to, I think, jump on that one. A second of our third one on this page, self-certification of hardship withdrawals. Now, I think that this is not so easy. It's going to be a little bit messy, I think, to have individual participants self-certify their hardship withdrawals. You get into paperwork issues. There are questions about how what happens if the employee loses or misplaces documentation, who bears the burden of proof in an audit. This one is a little bit more complicated, a little too messy. I just stay away from that for now. Third item on this page, life annuities. We talked a little bit about a special annuity, the QLAC earlier. Secure 2.0 also encourages more use of commercial annuities in retirement accounts by liberalizing certain rules. The payment increases of up to 5% are permitted. There's liberalization on using some additional dividend payments. There are death benefits that have been liberalized as well. So annuity contracts might become a little bit more popular with 2.0. Let's move on to the next slide, automatic portability services. The big takeaway there is that when an employer leaves account balance less than 7,000, default to an IRA, don't need consent, but there are a lot of restrictions associated with this, so proceed with caution. I put up a yellow flag with that, but it sweetens the pot for transferring, allows fees to be accrued, so it makes it a little bit simpler to transfer without incurring, or without the participant having to incur potential penalties as well, if they can just get it transferred pretty easily to another retirement plan. Let's move on to the next slide, please. These last slide and a half are grab bag provisions. Let's just move through these fairly quickly because they're not going to apply to a lot of people. The Savers Match. Savers Match is revised what was formerly known as the Savers Credit, which allows qualified individuals, low and income people to participate in a retirement plan. That's modified something for lower income as well as we've seen higher income, people who have extra money to put into a QLAC. Our other item on this page, well, I'm still looking at the prior slide. Governmental 457B plans requires employers to eliminate the first day of the month requirement. So now they can change their deferral elections more liberally. Now we're on to the cash balance variable interest rate crediting rule, which is right here. This is going to liberalize rules for pay structures, so that more money can be put to older, higher earning professionals. And with that, I think that we've reached the last item here, retiree health benefits. We get a little extra kick for defined benefit plans. They can add a little bit more money to a retiree healthcare plan. So now we come to the end. Conclusions. As you may have seen, Secure 2.0 isn't a logical scheme. It's a work in progress. There are some things that are simpler, which I pointed out, some things that are more complex. Secure 2.0 generally is going to require a plan amendment. That's not going to generally be required until 2026. These changes can be made now, but check with your record keeper, check with your TPA. Until they can make a change, you can't. All right. We've got maybe a minute for questions, but I hope if we haven't been able to answer them in the chat, we can append some to the presentation. All right. But thank you very much for your time and attention. I appreciate it.